Well, we've now looked at all of the basic process costing work. We've considered losses and gains, if you wish. We've also looked at dealing with work in progress. There's only one tiny little area that we still have to know in this. It's still to do with process costing, but I always consider it as very much a wholly separate topic, simply because that is the way it is examined. What we're looking at is an area called joint products and byproducts. You see, the whole problem we have goes back to the original observation about process costing, and that is that in process we are not able to separate one unit from another. You see, when we look at a joint product, what we mean is this. The output from the process will have two or more products, 2+ products, with substantial sales value. Right at the very beginning of process costing, I suggested to you that an oil refinery was a good example of process costing, because when the oil is being refined, we don't wish to separate 1 litre from another. So, with my phenomenal knowledge of oil refining, I'm pouring in a barrel of oil at the front of the process, and out of the back of the process, what do we get? Well, the outputs of an oil refinery will include such things as petrol for cars, diesel for cars and lorries, aviation fuel and heavy fuel oil, amongst many other elements. So the problem we have is, how do we place a cost individually for each of these? How do we place a cost on petrol that is different to a cost on diesel, that is different to a cost of kerosene, aviation fuel? That is the problem that we have. And of course, it arises from the whole point about process costing. If you can't separate 1 litre from another in the process, this is always going to be a problematic issue. Before we get down to that bit, let's look at the easy bit first. We also have to look at a byproduct. Now, a byproduct is a product with relatively low sales value. So in total terms, it may be worth quite a lot, but relative to the other products, it is not important. In essence, you would never run the process to get the byproduct. You are running the process to generate the joint products. And, as a lucky coincidence, you get the byproduct as well. Maybe you could say that oil refining generates tar, yes? Substances that you will have to get rid of or maybe be able to sell. That could be a byproduct. So, let's look at the easy bit first. The accounting treatment of byproducts. What do we have to do with them? I've got a feeling some of you have already got an idea. You see, a byproduct sounds to me very much like scrap value of normal loss. Remember, scrap value of normal loss was where we dumped off our waste and got some measure of return. And what do we do with scrap value of normal loss? If you remember, we did not treat it as income in its own right. Instead, what we did was we just took that income and offset the income against the process costs. I don't think it would surprise you that we do exactly the same thing with byproduct income. income is offset against process costs. A very simple idea, please remember it, because when we do these sort of questions, the first thing you want to do is to offset this to get your net value. So what we want to look at now is how we deal with our joint products. What's our problem? Well, the problem is simply this. What cost is charged to the individual products? And the answer is, well, can we link our process costs to the individual product accurately? Remember, we've got petrol coming out, diesel coming out, aviation fuel coming out. Is it possible to separately identify a cost for one from a cost to the other? And the answer is, I say it a third time, in process we can't separate 1 litre from another. And if we can't separate 1 litre from another, we are unable to link the costs accurately to individual products. Our only solution is not much of one. We apportion the costs in some fair way. Even when I write it, I'm thinking this is pretty weak. What is fair? I think we all know that life is not fair, don't we? E.g., we could apportion based on sales value. Or we could apportion based on physical units. You know, per litre or per kilo. That's basically it. There's nothing more sophisticated that we can do. Why don't we look at a nice simple question to illustrate the problem for us? A question on joint products. What have we got here? Well, here's something I prepared earlier. We've got some total process costs. Notice some byproduct income. Of course, we're going to offset that against the costs. Then we're given 2 products, imaginatively called A and B. We know the number of kilos, 5,000 of A, 3,000 of B, and we know the selling price, 5 and 8.33. So what are we going to do first of all? Well, of course, the first thing to remember is to establish the net process costs. In simple terms, we'll have the input costs minus the byproduct income. Simple as that. So, input costs, we said, were 41,000. Byproduct income, 1,000. We end up with a nice, simple 40,000. Very simple stuff, but you must make sure you remember it. Now we want to look at spreading these costs in some way across the products. Of course, one methodology is to use physical units. The idea being that we spread the cost in proportion here to the number of kilos. Therefore, our cost per unit is going to be, well, we know what the cost is, 40,000, and it's a simple case of spreading that cost over the total number of kilos. 5,000 kilos for A and 3,000 kilos for B. 40 divided by 8, I can do that, $5 per unit. Is it fair to spread the cost in this way? Well, the answer is, I don't know. It could be fair. If we were to look at a profit statement, we have our two products, A and B, and total. If we looked at our sales value, what was the selling price for A? Well, looking back, the selling price for A was $5. The selling price for B was $8.33. So, the sales value for A, 5 multiplied by 5,000, $25,000. The sales value for B, 8.33 multiplied by 3,000 comes to also $25,000, a total of $50,000. If we now look at the costs, we had 5,000 units of A at $5. And 3,000 units of B at $5, a total of 40,000. So, when it comes to profit, A doesn't do at all well, generates no profit. B does particularly well, generates all the profit. Is it fair? Well, you could say it's not fair. Having said that, you could also argue, because we're basing it on physical units, it is the fairest manner. Remember, whatever we do, there is an element of guesswork and nothing more. So what alternative do we have? Well, the alternative we have is to use sales value. And if that's the case, we might as well do the profit statement as we're doing our allocation. If we look at the profit statement, we've got A and B and a total. And if you think about it, we already know our sales value. We said it was $25,000 for A and $25,000 for B. A total of $50,000. So when we come to apportion the cost, shouldn't be too difficult. We've got a cost of $40,000. We're going to apportion it. Well, the numbers couldn't be easier. We're going to apportion it equally across A and B. 20,000 to A, 20,000 to B. That means, of course, that when it comes to profit, both will generate proportionately equal profit, because that's the nature of the beast. So is this fair? Well, you could argue, yes, it is fair, because it's reflective of the fact that both products arise from the process, and maybe we should give the same amount of profit back to each. But if we look at it another way, what happens if you consider the cost per kilo? If we looked at A, we had 5,000 kilos. 20,000 divided by 5 gives us $4. And if we look at the cost per kilo for B, we have $20,000 and 3,000 kilos, a cost per kilo of 6.67. Can we justify costing one thing at a higher value than another? The answer is, I don't know. This is all arbitrary. We are finding some way of spreading the costs, but we are not making any informed judgment from this as to which is the appropriate. At the end of the day, you pays your money, you makes your choice. Okay, that is the very end of looking at process costing. Complete, absolutely no more. So there is one more costing methodology that we have to focus on, something called service costing. Now, when we look at service costing, there is no methodology as such. In fact, what we're focusing on here is simply the things that are different for services rather than products. You see, the first thing we have to remember about service costing is that we could use job costing, Or we could use batch costing, or we could even use process costing as the basis to establish our cost per unit. What we must consider, however, are those things that make service costing different. So if we look at the differences to product costing, first, we have the environment. We would expect no production costs. So you could argue it's quite difficult to establish some sort of cost of sale figure. Secondly, we would expect minimal material costs. The nature of the service is that often it is intangible. Therefore, there will be no material costs or very little in relation to the other costs. We would often expect high overhead. And of course, there is a big issue here of associating that overhead with the product accurately. And we may have high labour cost. So, we're looking at this sort of environment. We've made a couple of observations. There are a couple of knock-on observations that arise from this. If we were to focus on materials, if we haven't got materials, we don't have a stock or inventory issue. We would expect minimal or zero inventory. So these are the sort of things that we would have to be aware of. From my perspective, the key issue is understanding the cost unit. Do you remember the cost unit often has two components? As I've stated when we talked about cost units originally, we have to identify to whom the service is being provided and what the service is. We talked about this at the time. If you had a railway, maybe you would talk about a passenger, the person to whom the service is provided, and the mile, the service being the distance that they travel. Or we could talk about a course, an accountancy course, the student course. Or we could talk about maybe the patient day, if we're in a hospital. So these are the sort of things that we have to focus on. Beyond that, there is very little to discuss with regard to service costing. You could argue that there is a difficulty associating service costs with the cost unit. I would certainly agree with that. But I don't think it is something that your examiner can easily get across in the exam format that we have. Be aware of these issues and you'll have no problem. I would guess, at most, we're looking at one single question in the exam on this sort of thing.